Hello and welcome to KYC, Know Your Company as the abbreviation suggests. It's a new show on NDTV Profit, and what we focus on is to try and cut the clutter in this fast-paced world of stock markets. Investors generally are bombarded with information, but what they lack often is deep comprehensive understanding of companies that they invest in. Know Your Company is a show designed to give the regular investor powerful, actionable insights into the fundamentals of single NSE listed companies daily. Now, quickly moving on to the company that we're going to look at today. We're going to look at Popular Vehicles. It's a distributor in the auto segment, and it's an auto retailer which was established in 1984 with Maruti. Headquartered in Kerala, it operates now a dealership with Maruti, Honda, JLR, Tata Motors, commercial vehicles, Ather Energy and Piaggio. Those are all the brands that they currently distribute. They employ over 10,000 people across 430 touch points across India. Now, key segments, let's pull those up as well, try and break that down. First off, new vehicles, 74% of their sales comes from there, 5% from spare parts. Services is the other larger chunk, 15%, and then pre-owned vehicles is 6%. What I would also want to try and break down and understand, and we'll have Puneet joining in just a minute, is how quickly is pre-owned vehicles growing, and can that growth rate kind of sustain? But that's the larger breakup in terms of the current revenue. I'm also going to try and break down, as we always do on each show, the fundamentals, and we at the end of all of that, we give you a rating. So let's start off with what our rating parameters are. First off, we look at the income statement before we look at the balance sheet, the cash flow and the return ratios on all the capital that the company continues investing. Shareholding, how that has evolved, along with street cred. What's the kind of return the stock has given? Along with street coverage, are analysts actually looking at the stock in a deep fashion? Is it a well-tracked, well-covered counter? And what do analysts believe is the upside or downside potential? That's street coverage. And last off, on the valuation picture, how does valuation stack up versus peers as well as other players in the similar kind of cohort? And we talk about all of that on this show. Let me first start off with income statement. Well, revenue currently sitting just shy of 6,000 crore. It's got a very strong revenue growth that it has clocked over the last few years. And I'll pull out not only the last year, but I'll also try and cull out from the last, say, 2021, when the top line was maybe just about 3,000 crore. Currently, top line sitting at roughly 5,600 crores, which is just shy of the 6,000 crore mark. So it's been a very healthy revenue growth that we've seen the company clock. EBITDA too has grown at a healthy pace, but what we've seen is it's not grown as quickly. So EBITDA has shrunk from 5%, EBITDA has shrunk to around 4% odd. And we'll try and add color to that, because is it just growth that they're focusing on currently, and which is why it shrunk? We'll try and get some more understanding on that. But profit after tax up 32%. So strong growth where PAT is concerned. PAT has gone in FY22 to sub 50 crore to now nearly 100 crore, nearly in FY24 on a consol basis. So that's how it's lining up in terms of numbers. But Puneet, let me first off welcome. Always good having you. Trying to understand from you, Puneet, how do the balance sheet metrics line up?
Well, definitely, there are a couple of data points when you look at the net debt to equity, especially It's trading at around the 0.6 times for net debt to equity specifically. And what's important is that, while the cash reserves have been maintained around 40 to 45 crores, the aspect that the gross debt is over 500 crores for a company like Popular. Now, the size of the balance sheet as well as, that's not too much, but this is not a key concern specifically because, it's an auto dealership. So it has to maintain roughly 30 to 50 days of inventory of cars in its warehouses. For that, of course, it needs this kind of working capital, which is generally, financed with the kind of debt that they've taken on a gross basis. But they do also maintain a decent cash balance of about 46 odd crores, which is roughly about 40 to 50% of their annual profit as well. So they have been maintaining that and increasing that steadily over the last 3 years as well. That's something that's something very positive for this company as well. But one of the other aspects, Harsh, is of course to also look at the cash flow of a business like this, because heavy cash investment needed to maintain that kind of inventory also has certain strains on the cash flow as well.
Yeah, and that's reflective, Puneet, of the balance sheet that we'll pull up very, very quickly. The cash flow per se, 80 crore is the cash flow from operations. But let's also break this down, because you have receivables which have doubled over the last year or so. From sub 40 crore, it's gone to 71 crore. And you have inventory, which has gone up 5x from around 35 odd crore to 150 plus crore. Those are the two metrics, in my view, which is impacting overall cash flow. In terms of the compounding, therefore, you're seeing a negative 6% on cash flow from operations. And that's where the likely negativity is starting to creep through. Can that change in a big fashion? Well, you would hope so. And if that does happen, of course, you may start seeing a tweak with regard to how one views cash flows as well within the company. But for now, you're seeing a negative 6% over the last 3 years in terms of cash flow from operations, largely led by these two, which are dragging numbers. Net cash flow has, though, been quite healthy in that sense. So somewhere there's been a balance, Puneet. And therefore, overall, we'll want that cash flow from operations to start to pick up. And therefore, that thumbs down view at the moment with regard to cash flow.
And another, I think one of the key metrics is, of course, the return ratios as well, which we do look at as well.
Yeah.
Now, the ROE is, of course, 11.6%, and the reason why it's actually fallen by 7 percentage points compared to last year, but that's largely because of the IPO proceeds that they got in 2024. So that's one of the key things, because they had increased that ROE to roughly about the 18% in FY23. The company has also spoken about this in the previous conference call, that it is expected to rise again in the next year once this excess cash is deployed. The other aspect is the ROCE, or the return on capital employed as well. That's very healthy at around 17.7 to 18 percentage points. And over the last 3 to 4 years, the company has been steadily increasing this and maintaining at least the 17% levels continuously over the last 4 years, despite the pandemic as well. So that's one of the key things, that they've been able to deploy cash very effectively, Harsh, and that's reflected in these numbers as well.
Well, yes, so cash deployment in that sense is effective, and return ratios therefore looking positive. We'd like to look at a turnaround both in inventory as well as with regard to receivables. So those are two metrics we'll track. But moving quickly on, you have shareholding, which is a key metric here, because what's happened over the last year or so, they've listed themselves, they've gone through an IPO process, they've listed themselves on exchanges, and 61% promoter ownership is what the shareholding stood at the start of immediately post listing on exchanges, and that's carried on over the last 2 to 3 quarters, which is obviously a positive of some sort, and it's definitely a thumbs up on that metric, because what you would expect is some amount of dilution post listing, but that's clearly not happened at all. So management remains very well invested in the company. 61% is a good shareholding as well. It's a healthy shareholding, more than 50%. Not only do they maintain control, it also signifies that they have confidence in the company. So both of those metrics, definitely a thumbs up on that count. One was return ratios, which Puneet covered, and one is the shareholding, which I covered. But let's talk about street cred, because returns not as healthy, right, Puneet?
Yeah, and it's been dragged because of the market conditions as well.
Yes.
Because this year we have seen a very slow movement of cars specifically, which is the majority of the revenues for a company like Popular. And that's one of the key things, that they have reported lower growth in Q2 as well as Q1 as well. Apart from that, what's interesting is that, which Harsh pointed out, the promoters, it's split equally between the three promoters, with Naveen Philip, who's the current MD as well, holding roughly about 20.39%, along with Mr. Francis Paul as well as John Paul, who hold the same stake. So it's been consistent. And the key aspect about the share price performance is, of course, reflected in its peer Landmark as well, which we'll get to eventually. The aspect that, the company is expecting better performance in the next year, both in terms of cars as well as commercial vehicles, because infrastructure spending has increased in this half, starting somewhere in the previous month of November as well as December. That was also absent in the first 6 months, largely because of elections as well as the monsoon. So both the companies, the passenger car segment was dragged down because of the very stupendous growth over the last 2 to 3 years. But the truck segment also wasn't working specifically because, the industry as a whole had come to a standstill in the first 6 months as well. So that's largely down the, dragged down the share price performance in this particular year. But of course, when we eventually get to valuation, that will be one of the positives to talk about as well, because it's now somewhere trading at a very interesting point, to say the least.
Yeah, and interesting you bring that up, because whenever you have a company trading at a decent valuation, you'll always have good street coverage coming through. But at the moment, we don't have any street coverage on this one, and therefore we give it a neutral. No street coverage whatsoever. Two drawbacks of that. One is you don't understand perspective. You don't get a perspective of an active analyst tracking a stock all the time. And second is, typically when an active analyst tracks it, you will have certain ESG or rather more governance parameters looked at in a more deeper fashion, which also we don't get, and therefore we'll hold on to the neutral rating on this one. But Puneet, let me quickly come across to you with regard to valuations. How do those stack up?
Well, it's very interesting for both the companies, because we're also comparing it with the listed peer, which is Landmark Cars as well. So for Popular, of course, it's trading at 13 times current price to earnings, since it does not have any kind of analyst coverage. We haven't taken forward PE of FY26 or 27. What's interesting with Landmark is the share price correction hasn't been as steep as something like a Popular vehicle. So when you look at price to earnings specifically, while the earnings have deteriorated for something like a Landmark, the price has stayed stagnant. And that's why we see the big disparity between both these price to earnings ratio for these companies. In terms of Popular vehicles, the numerator, the price has corrected while the earnings have corrected as well. And that's why you can see that the 13 times current price to earnings looks, decent, and the disparity is there. But over the next year, when, performance increases for both these companies in terms of better market conditions, as well as, the passenger car segment also showing some growth compared to the previous year, because of course FY25 will be a low base in FY26. So that's also going to correct slightly. It is expected that, something like a Popular vehicles, where the earnings might increase in the next year, will also have some kind of positive price movement. But currently, Ash, it's very interesting what's happening in both these players, because there's not too much competition, or at least in the listed space. While on the private side, there's a lot of competition with razor thin margins, of course. But for something like a Popular vehicles, the price has corrected to a point with respect to its fall in earnings in this particular year. And that's why we see, it being, cannot call it undervalued per se, because the earnings have fallen, but definitely when compared to something like a Landmark Cars, it's at that adjacent point as well.
Fair point. Lower growth, but at a cheaper valuation, as is generally the case. You pay more for growth. But let's quickly break down on all that we've discussed in terms of performance parameters. Income statement we spoke about, positive. Balance sheet check was positive. Cash flow was negative because of a couple of one-offs that we spoke about. Return ratios was positive as well. Shareholding positive, street cred negative because of the returns given post IPO. Street coverage is neutral, and valuation picture is positive, giving us a rating of 5.5. But let's go across to the management, shift focus. Puneet, of course, spoke with the company's MD and promoter, Naveen Philip, and he chatted about the company's growth plans ahead, as well as what can we expect in terms of guidance. Listen into a slice of that conversation.
So we are spread across the entire automobile sector. So we have two-wheeler, three-wheeler, we have passenger cars and commercial vehicles. And then we also have distribution of spare parts and the used vehicles per se. In terms of brands, we are associated with very limited brands per se. So in passenger vehicles, we are associated with Maruti, we are associated with Jaguar Land Rover and Honda. In commercial vehicles with Tata Motors and Bharat Benz. Two-wheelers, EV two-wheelers with Ather and EV three-wheelers with Piaggio. In terms of distribution of spare parts, we have far more brands because it's a much larger in terms of we have both Tata Passenger, Tata Commercial, Maruti, JCB, Ashok Leyland. We are agnostic over there. In terms of a strategy going into the future, and this has been a philosophy from day one, and we have repeated it even during the IPO and post, is in terms of building up our service infrastructure in the passenger car business and in terms of having an overall coverage of all categories of the automobile sector. Here, Maruti being the largest brand for the last 40 years plus, the base for service, that is the number of vehicles at the car park that is already present in the country, is the largest for Maruti. So our expansion in service and the expansion to other states and all that would predominantly be Maruti-led in terms of the passenger vehicles. In terms of luxury vehicles, we are present with Jaguar Land Rover. Here again, we would like to keep growing with Jaguar Land Rover and maybe add one more brand in the luxury vehicle portfolio. We are very concentrated in terms of our brand addition. So we are in terms of very focused with the players that we already there with in terms of OEM and we believe that is our strength in terms of long-standing relationship with the OEMs and having a much larger area coverage and in terms of depth. In commercial vehicles, we have been with Tata Motors for the last 27, 28 years. We are already present in 2 states. We would like to keep expanding with them. Similarly with Bharat Benz since the inception. So overall strategy is that in terms of continuing to be with the brands that we have and growing with them per se, instead of just adding brands on that. In terms of two-wheelers, we have added, we've got into that space only about 2 years ago with Ather. Continue to be happy with the Ather, and Ather is also going for an IPO. And again here, would like to expand with Ather into other states also. And that's our philosophy per se. Three-wheeler as a market, we've seen some troubles in terms of because of the FAME subsidy and all that. So we are still evaluating whether we want to be in that space.
The second question, Mr. Philip, I just wanted to continue the point because the reason I asked for brand addition is because, according to your RHP also, there are either auto dealerships with a single brand across states or, multi-brands as your, only listed player has roughly 10 brands currently operating. You're somewhere, positioned in the middle. So I just wanted to ask, because this year has seen slowdown across the passenger cars as well as the truck segment as well. And it's visible because of market conditions. So, and while you mentioned that your two-wheeler business is only 2 years old, so in terms of revenue, it might have lower contribution. But if we get kind of like a slowdown, what would be the company's strategy in case of a similar issue in terms of, brand additions as well?
Yeah, so our strategy doesn't change because 1 year is a slowdown. And as I said, our focus is in terms of building up our service facilities and service partnership per se. And last year we serviced about 1 million vehicles. And we continue to focus on that and build that as our strength area. And for that, we don't need to have multiple brands as a strategy. With the same brands that we have, there's enough scope to grow. And that's the focus that we have, both in terms of across geographies and within that brand in the states that we are.
Now, Mr. Philip, I just wanted to take forward this point because, working capital is one of the mainstay of any auto dealerships because, you have to maintain the car stocks in the inventory as well. I wanted to understand what kind of contribution that you're targeting from the non-new vehicle sales portfolio as well, mainly the pre-owned vehicles, spares, as well as the service business. Because this will help you offset some of the high interest costs of maintaining working capital and inventory. While I know you're on silent period for Q3, what would be the FY26 and 27 targets coming from these 3 businesses firstly?
If you look at our last year's numbers or the year before last, in terms of last year, we delivered a PAT of about 76 crores. So approximately 15% of our turnover comes from our service business. So last year we had a turnover of approximately 5,000 crores, about 750 crores came from our service business. But close to about 56% service and spares business, but close to about 56% of our EBITDA came from our service and spares business. And if you look at what goes down to the PAT level, it would be closer to about 70-75% from the service and spares business. And which is why we keep stressing that we would like to build that service portfolio up, because that's a more consistent business. And I mean, there's no inventory stock involved in that except for a very 30 days of spare stock that is involved. So that is where our focus is in terms of. As you rightly said, the turnover per se, out of the 5,000 crores, 80% of our turnover comes from new vehicles. But that contribution of the new vehicles into EBITDA levels and into PAT levels, that's much lower in terms of percentage contribution per se. So that's where we want to focus on building our service franchising, and that's been our philosophy through all these years that we have. And going back to the statement that I made initially, and for that we don't need to have multiple brand additions, because if you look at the car park, the car park consists mainly of 3 or 4 players. That is Maruti, Hyundai, Tata and Mahindra. If you look at these 4 players, probably approximately about 85% of the car park lies there. Coming to this year specific, and in terms of H1, it's been muted because the interest costs that have piled up has taken the sheen out of our bottom line numbers. We were carrying in the initial months, starting from April till about August, September, we were carrying, in terms of passenger vehicles, closer to a 75 to 90 days of stock. That has slowly started coming down, and I think that would start showing in the results going forward. So, since we are in the silent period, I'm not getting into numbers of Q3 specifically, but I'll give you an overall trend. So over the last 5 years, we've been clocking a CAGR in our spares and service business of approximately 20%. And the contribution, which was, as I said, it was 15% last year. That contribution 3-4 years back was about 11%. Okay. So that's the growth that we would like to maintain, and we're confident of maintaining going forward over the next 2-3 years. So 1 year might be a blip here and there, but over a trend of 3-4 years, we would still like to grow at about 20 to 25%. And we are quite confident of delivering those. And as we grow in that number, the contribution, as I said, from 11% to 15% of turnover, that would further go up, and in terms of our EBITDA margins, and in terms of our PAT.
Now, Mr. Philip, electric vehicles has been an up-and-coming segment post the pandemic, especially, since the focus on personal mobility. Now, while in 2024, we saw roughly about 1 lakh electric vehicles sold in the country, in terms of four-wheeler cars, still a small share of the overall 40 lakh vehicles sold in 2024. I want to understand your strategy in terms of electric vehicles, because the brand that you operate in, mainly Maruti, is looking to launch an electric vehicle in this particular quarter. And it's mainly dominated by brands such as Tata Motors, Kia and MG, who have taken a steadfast approach to electric vehicles. How does an EV brand addition for you work? And in terms of the service business as well of electric vehicles, how would it be different from a traditional diesel or petrol service business in terms of revenue as well as margins as well?
So if you look at in terms of, Maruti is launching their EV Vitara in terms of, it will be there at the Bharat Mobility Auto Show. If you look at EVs across the world, they're actually very disparate in terms of, so if you look at China's EV penetration and population or sales per year has gone up drastically. But whereas if you look at the other extreme of US, it has gone down consistently. And in Europe also, earlier the target was that by 2030, everything should be alternate fuels or EV specifically. They have moved that timeline from 2030 to 2040 in terms of adaptation. Large companies like Mercedes, all of them have stepped back on the EV portfolio and EV business per se. So we don't know how it will play out in India, whether it's just EVs or hybrids that will do well, biofuel, CNG. You also have hydrogen cells, everything coming in. So it's a mix that will go over the next 3-4 years. How does it impact us as a dealer is the question. In terms of service business, if it is only an EV portfolio, definitely services come down by about 10, the regular service, because moving parts are lower. But if you look at, even as I said earlier, in terms of our revenues, the EBITDA contribution, 55% of our EBITDA came from service and spares business. So if you look at 4 million vehicles that will probably get sold this year, will probably go to about 8 million vehicles by 2030. We are looking at this year, the penetration of EVs, as you said, is only 1 lakh on 40 vehicles, 40 lakh vehicles, about 2.5%, 3%. It will probably move up to the most optimistic of estimates is that will go to 30%. But we would look at, I mean, if you look at what the trend is, it'll probably be around 17, 18%, which means even in 2030, that out of the 8 million vehicles that is estimated to be sold, 6 million would be ICE or hybrid or a combination of those. And about 2 million vehicles would be probably EV, which means that from now to 2030, we are going to see at least about 25 million ICE and hybrid vehicles going to be added. Okay, and that will sustain service for the next 10 years to come. Because usually the service period is at least over 5 to 7 years. So that's one. Out of the 55% EBITDA that we generated last year, close to about 70% came from our accident repair business or body shop business. Now that, whether it's an EV or an ICE engine or any other powertrain, the accident repair business doesn't get affected because the more number of vehicles on road, the number of two-wheelers penetration, three-wheeler penetration, everything, accident rates have not come down. It only has gone up. And even in highly regulated markets where you have ADS and all that, even in US, China, everything, accident rates have never come down. So that's where our concentration is. So our accident repair is concentrated mainly on our passenger vehicle thing. Because if you look at commercial vehicles, though accidents are there, the repair, so you should look at accidents as not just major accidents. I'm talking of small scratches on the vehicles, a small dent on the vehicle. A commercial vehicle operator would not repair it immediately unless the vehicle stops running because he or she has to generate money out of the commercial vehicle. In terms of passenger vehicle, the thought process is very different. The owner wants the vehicle to look spick and span. So even a small scratch dent is repaired on, and that is where there is a flow of revenue also.
Now, Mr. Philip, we did speak about brand addition, and another aspect is, of course, geographic expansion. Now, as of your Q2 presentation, you have roughly about 60% of your total revenues coming from Kerala, about 25% from Tamil Nadu, and roughly 10% from Karnataka. But, the first two states are, of course, the mainstay. You have been operational for the last 40 years. I wanted to understand your strategy for geographic expansion since you've added Maharashtra as well over the last 3 to 4 years. What's the company's strategy going forward with this in terms of increasing your current presence in major states going forward?
So as we said, the reason I'm saying a lot of people ask why we've stuck on in Kerala, it's been 40 years, all that. The fact of the matter is that Kerala is one of the highest penetrated passenger car markets in the country. The number of cars per thousand in Kerala is double that of the national average. And hence penetration, car park, service availability was all very high.
Well, out of time on this edition of KYC. Thanks, Puneet, for joining us and giving us all that perspective. But for now, from me, everyone who puts the show together, including Puneet, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.